We're glad to have you back. Well, we continue this conversation. Well, let's look at the last big story in the world of business and the economy. The central bank has voted to retain monetary policy rates at 27.5%. That follows the 300 meeting which held in Abuja. This was disclosed by the Apex Bank's governor, Sola Cardoso, during the post-MPC press briefing, as always, a day after that meeting. Now, all 12 MPC members voted unanimously to maintain current policy rates, according to him. The decision demonstrates the committee's cautious approach to monetary management as it continues to assess prevailing macroeconomic conditions and the effectiveness of recent tightening measures. The CBN heightened the recent moderation in Nigeria's inflation rate, which is 23.71% in April from 24.23% in March. That's according to latest data from the National Bureau of Statistics. The CBN also considered some global issues that might shape projected outlooks in the coming months. Well, let's talk to Mr. Robert Omotunde, who's the Chief Investment Officer at AfriInvest West Africa. Thank you so much. It's good to have you in. I'm sure you heard Prof taking us through the oil and gas industry. I want you to take us through the monetary side and, of course, other economic issues. First, let's start with the MPC meeting and what that means. How does it come to you staying with those figures and staying with the retaining those figures? How does that come to you?
Well, I think that it's much in line with what most market watchers expected. Speaking specifically now to the decision of the MPC to retain MPR at 27.5%.
Yes.
Again, the normal considerations which the MPC also put forward is the state of the economy from an inflationary perspective. You know, inflation since the rebasing exercise has moved from between 23 to 24% level. You know, you saw 23 to 24, and then to 23, now to 24,
yes.
You know. So we keep oscillating between that 23 and 24% level. That be said that, you know, although it's much lower compared to what we used to have pre-rebasing exercise, you know, it still shows that inflationary pressure is present. And those are some of the considerations of the MPC. Perhaps reducing MPR may be premature in their wisdom, you know, because if you reduce MPR at this point, it may also send a signal of an easing cycle to the market. And once that signal is sent, it can also pressure the currency, where we can see that the central bank seems to have made some very good progress. You know, should I say since the beginning of this year, you know, we've seen exchange rates trending not higher than, you know, 1,650 levels, you know, since the beginning of the year, because that stability in itself, it's some measure of progress.
Yeah.
Because again, when you have a currency that is weak and is not stable, and you're seeing, you know, oscillation most likely around the threatening territory, you know, it impacts a lot on policy decisions and also the normal workings of the market. So that the central bank has been able to maintain that stability is something good, which of course the MPC also alluded to, for which is decided to, you know, retain MPR at 27.5%. Now, one we argue that MPR at 27.5% with market rates at about maybe maximum of 25% from government issued securities, it still suggests somewhat that perhaps MPC could have, you know, reduced MPR to somewhere around that corridor. But of course, the signaling is what the MPC was very cautious about, to ensure that, you know, they are not, you know, cutting rates prematurely, so that it doesn't, you know, really impact on the overall well-being of the economy. So, like I said, it was largely expected that a hold, you know, was not out of place, you know, from what the central bank has done. We can analyze how much of impact that is still having on the fiscal finances of government, given the level of borrowing. But to a very large extent, I think that, you know, like we always say, monetary policy rate is an anchor rate. You know, as you may be aware, MPR is not the rate that people transact.
That's the bigger picture.
Oh, yes, because again, you even see the asymmetric corridor around the MPR. You know, MPC saying plus 500 basis point, minus 100 basis point, which implies that if the banks were to borrow funds from the central bank today, they will borrow at around 32.5%. But if they were to give money to the central bank for interest, like a deposit, they will give that at around 26.5%. So that's to tell us that MPR is not exactly the rate at which transactions are done. You won't get your loan technically, if it's a commercial loan, at that rate, much higher. But it's just a guide. So what we are beginning to see is that, you know, suppliers of, or those who are responsible for issuing securities, both on the government side and on the private sector side, they are taking their own initiatives to use whatever powers they have within their influence to actually guide what rate they expect. For instance, if you look at Treasury bills rate now, maximum that you will find in terms of yield, even from primary issuance, is still technically around 25%. You know, of course, if it's commercial paper, you know, which are issued by corporates, you may still get that inching closer to a 30% threshold. But by and large, because in the domestic market, for example, the DMO, Debt Management Office, issues securities on behalf of government for them to raise funds to fund budget deficit. And they are responsible for treasury bills as well as local bonds. To that extent, for instance, if you look at the long end bond now, the DMO has stayed within the 20% threshold or below that, you know, even for the longest bonds that they have on issuance. So that tells us that even though the MPC has that rate at the level that it is, the market can still, you know, dictate the pace at which they want to trend. And it is the decision of the DMO that will then guide how other market rates will move. For instance, if the DMO should issue a security today at the primary auction that sells for around 15%, don't mind MPR at 27.5%. You will see other market rates, including commercial papers, gravitate towards that level. So to some degree, it seems as though the fiscal guys too have some sort of influence around what monetary policy does, because MPR is kept at 27.5, but like I said, the highest market rate today from the government is not up to 27%. It's around 25% threshold for the short term, which is treasury bills. If it's long end, it's even much lower at 20%. So the longest trading bond in Nigeria today, relative to MPR, is at least 750 basis points lower than where MPR is. You see what I mean? So that way, the fiscal authority is able to still help government to manage the debt burden, because of course, as MPR is high up there, imagine you know, market securities as high as that at that level, it will impact on what the the government government servicing, debt servicing cost will be. So to some extent, MPR can remain where it is, and it's not just a Nigerian phenomenon; it's global, where you will see the policy rate at, I mean, just check for the US, for example, where the policy rate is relative to where market rate, they have like a reverse of what Nigeria has. US policy rate currently, I think, around 4.5% levels, but you see longest trading bond in the US above 5%, which means that, the market has some sort of influence on where the market will trade. I think the government can take solace in that, as it helps us to balance out, our fiscal challenges, especially that government has to borrow amidst global oil, lower prices. Lower prices, yes, relative to the budget,
And that's scary as we move on with our budget implementation. Do we have other options looking inwards now when we talk about revenue generation? The FRS saying, we're going to buckle up, we're going to do this. But one way or the other, I still think we need to get some money outside shows. Of
course. So what the government will be planning to do now is possibly to increase the borrowing level, because let's understand our peculiar situation. We are not a country that can just easily say, okay, because we have challenges from oil prices, let's now see other ways to make it. Doesn't work that fast. Because if you do it that fast, the other option, yes, is to now tax people more, and even to tax, you still need to put forward the bills that will still go through the National Assembly, even if you say
we're still waiting for the tax bills.
Exactly. So even if you say the National Assembly is a friend of government, it will still take some time. It might not be able to meet up with the current year's budget. So the other option the government has, apart from increasing the amount of borrowing that they have to do, is to consolidate, right, again, I always say it, most times when there are challenges with the budget, something suffers, you know, from the expenditure profile of government. You know, you have the recurrent lines and the capital expenditure lines. You know, the capital expenditure tends to suffer because, of course, you cannot shut down government. Government will continue to run. So what you typically find is that there may be a reduction in amount of capital projects, though it's not so good for us. You know, what we are now beginning to advocate is that we should also look inward, you know, probe into some of these recurrent expenditure to bring down the, you know, expenditure profile of governments, you know, where it is practicable. But, you know, we can't do that if we don't have the intention to run more efficiently. So, you mean in times like this, perhaps you want to run more efficiently on the recurrent side so that, you know, you don't just put the entire deficit between your revenue and, you know, expenditure plan on the capital project. You know, because capital projects are essential for us to catalyze the economy, create jobs, you know. And, you know, when you create jobs and we have enabling environment that, you know, facilitate a lot of economic activities, the tax revenue of government from the non-oil side will also improve, you know. But again, there are no quick fixes to shocks, I mean, resulting from, you know, external factors like global oil prices, as the case may be. The other thing we can do is to ramp up production, which I think the government is trying on that part. But, you know, we still have a long way, you know, relative to, apart from the fact that we are not seeing as much investment. You know, you've discussed with Prof, you know, just before I came on the job. We are not seeing as much investment, you know, to attract in that oil and gas space. So, again, the options are not so much for the government in times like this.
Let's talk about our currency and what this administration has been doing for the past 2 years. You know, we saw that bold step. Don't let us go back to that. We know what's been happening. And at the last meeting, the CBN governor said clearly, he said Naira is now getting more competitive than it used to be. You are an economist, and you would understand this better than I do. What do you make of that line? And how do you, you know, side by side with the exchange rates that we have at the moment? A bit of stability, I know, but what do you make of our currency?
I think to some extent, I will agree with the central bank statement. Now, the reason being that we know where we were this time last year.
Yeah, true.
You know, we know all of the instability that the currency has gone through, and we all can also see the stability that we're experiencing at the moment. You know, so it is foolhardy to deny progress that you can see. So I must commend the effort of the central bank in ensuring that at least we are stable. You know, sometimes when we talk about, when we analyze macroeconomic issues, the greatest problem that an economy we have is uncertainty. Uncertainty when I don't know the next thing that will happen. You know, and those were the issues we had when we had those fluctuations in currency, that last week you will see 1,004 and the next week is 1,006 and the next week is 1,008. You know, those sort of instability is not good for any economy. But what we are beginning to see now is some stability that people can plan and say, okay, on the basis of the stability that we have enjoyed over the last 3 months, I can plan that the worst of currency I would see is around 1,650, and maybe the best I will see in around 1,004. Now, that in itself is some progress that I think the government has made. Now, we are not going to relax and just expect that, you know, it will continue like that. We still need to put in more effort. The confidence building that the central bank is doing in, assuring a lot of foreign portfolio investors that, you know, Nigeria is safe for business. You can also plan around our currency. It's a good effort. Now, there are efforts to get Nigeria enlisted again in the JP Morgan Emerging Market Bond Index. You know, we were kicked out of that index in 2015. Now, by the time we get into that index, it also helps us, because what it means is that once we are in that JP Morgan Emerging Market Bond Index, those who have indices that are tracking those markets, they then see Nigeria as in their radar again. Because we are out, they cannot touch Nigeria. They cannot even look at it. Exactly. So, but now they see Nigeria in their radar, and then they begin to inflow those funds, right? And it can even help us overall in stabilizing, you know, our interest rates, which then invariably forces the hand of the central bank to bring down MPR, as we have always seen, you know, in the past. Now, as those flows are coming in, they also strengthen the currency, because it then means more money in our reserves, more stronger ability of the central bank to defend the currency. And of course, if there are no speculations, then you could even get the currency down to 1,000 or below. You know, I've analyzed before that if you check on a relative basis, one of the ways we value an asset is to look at relative pricing of that asset, you know, when you compare them to peers. Now, in terms of economic standing, Nigeria seems to be better in economic standing than most of the neighboring countries to Nigeria, like Ghana, Republic of Benin, Cameroon, you know, and Chad. But when you look at the currency of these countries relative to the USD, you cannot explain why Nigeria is 1,006. And then most of those countries, Cameroon, for example, is just around 600 or thereabout to the dollar of their own currency. No, so on a relative basis, it looks like this currency is currently undervalued, you know, when you look at it. And by that, I mean that our currency can much more go lower if the right policies are in place.
So like 1,000?
Do you understand? Even below.
Even less than.
You know, because I gave you an instance, you know, from an economic standpoint, you would argue that we are still a more stable and reliable economy than a Cameroon. Yeah, true. But Cameroon has an exchange rate that is, you know, below 1,000 relative to the dollar. So if you're coming to Nigeria with your Cameroonian currency, 1,000 of Cameroonian currency, you will exchange for almost 3,000 naira. That is unexplainable, you know, by any, I mean, and this is a stronger economy, you know, and I'm just looking at it from a relative, you know, standpoint. You know, pricing is a function of demand and supply. So when demand is artificially driven, which is the case that Nigeria has suffered over the period, you know, and like I always argue, it's artificial because people are speculating on the currency. But the wrong approach would be to say, you know, you want to start arresting speculators. And I say, no, that is not done anywhere in the world. Your policy is to put policies in place that will discourage speculators or that will make speculators lose so big when they try to speculate on your currency. So because once we can eliminate those, you know, artificial demands coming into our own currency, because people are demanding for the dollars because they think that it is easier for them. They can protect themselves. But the moment your currency is stable, just like the governor was saying that Nigeria, Naira is becoming more, you know, competitive. Now, if it becomes more competitive, I will be careful the way I want to hold the USD. You know, so I will demand more for the local currency. If I know, for instance, if it's a known fact today that Nigerian Naira will exchange to the dollar 500 Naira in 1 month, if it's a known fact and everybody believes it, you will be shocked that Nigerian Naira will exchange for 100 Naira because of that speculative activity as well. I don't know if you get my point. It's like the reverse of the speculation. If everybody suddenly believes that Nigerian Naira will exchange for 500, 500 Naira will, a dollar will be 500 Naira in the next 1 month, you will be shocked the way our currency will appreciate. You could get to 100 Naira to $1 in 1 week. But it works with the consensus. True. You know, so and for that consensus to be built, it comes with people believing in what the government is doing and trusting that they would rather flow with the government or they lose out.
Let's wrap up with trade policies, industrial policies, and all of that, because we need to also have all of this side by side with this monetary side trying to effect all of these changes and all. Do you think we're having the right conversations around that space? We're not talking too much about even the AfCFTA, but what do you think about our trade, industrial policies, and all of that?
I think that's the much of deepening that the government needs to do. You know, in the past government, you know, still under this party that we are in now, we had a lot of conversation around ease of doing business, you know, and so many things that need to be done to facilitate the ease of doing business. I think that trade activities, you know, coming into our country by way of foreign direct investment, we also come when people believe in the policy that we have, you know, within the country. How easy is it for you to set up a business in Nigeria? Now, I must say that the government has done well in that regard. You know, as we speak today, people can register businesses, you know, say under 1 week, you know, and that improvement has been sustained for more than 5 years now, I believe. You know, so to a very large extent, we're doing well in some regard. But I think it's still more in the area of, you know, people coming in and being able to easily, run their businesses? Do we have tax incentives for businesses that are coming? How easy are small, medium-scale enterprises finding it, to thrive within our economy? Those are conversations that will enable people to now say, okay, let's inflow money and do business in Nigeria. But I must say that although that's on an individual level, you should speak to some, investors coming from outside Nigeria. They will tell you that Nigerians always see problems, but when they come, they see opportunities.
That's it.
So now, but we must get to the point when it's not just foreign investors that see the opportunities, but everybody, because like I said, you can't argue with facts. You can't argue with data. When you come and you see that, okay, this is a known fact about doing business in Nigeria. So whether you are local or foreign, you will just, flow with it. So we must get to that point where everybody believes, in whatever we have on ground. But again, it takes time. It takes people trusting the government, and, it takes a lot of work, generally speaking. Interesting conversation. Just like you, I just talked to Prof. There's never enough time to analyze this. But thank you. That's our time today. Thank you for having me. Thank you for coming on the show. As always, we appreciate you coming down to the studio, having these conversations with us. So Robert Omotunde is the Chief Investment Officer. He is with AfriInvest West Africa. They're breaking down the economic issues, of course, and what we see with President Bola Tinubu's reforms in 2 years. Well, let's look at markets before we wrap up the show for today. The market is closing in positive. It looks like a good one for the last week, for the month of May. Mr. Dele Sanusi is an equities trader with Rostrum Investments and Securities Limited. Mr. Sanusi, good afternoon. Take us through this beautiful performance that we see today at the exchange.